Okay, this is the third mini recording of Chapter 12 on non-qualified deferred compensation plans. So we are going to get into stock options, and so we're going to talk about incentive stock options, non-qualified stock options, and stock appreciation rights. This is going to take us through, I think, about slide 39. And we're going to do some examples of these in class. That we'll go over some of the examples that are in the PowerPoints, but we will do some examples of these as in-class exercises. So the employer stock options and stock plans. So you'll probably see if you work with any executives in your career, you'll see these, and not even just executives, but you'll see these for fairly highly compensated employees. So we'll get into these here. Incentive stock options and non-qualified stock options. Incentive stock options we'll get into first. They're also known as statutory stock options in this class. Sometimes we call them qualified stock options. That's not the proper name for them, but they, like qualified plans, they have special tax treatment. And so there are limitations on, they can only be granted to employees. You can't gift incentive stock. If you're an employee, you can't gift the option to someone else. You have to exercise it and then gift it to them. They can't be granted to someone who is, say, a member of the board of directors who's not an employee. It can only be granted to employees. The aggregate fair market value of the incentive stock option must be less than $100,000 per year per executive, and so typically we'll see that the strike price or the exercise price is at the fair market value. So when they're granted, typically they don't currently have any what is known as in-the-money value in the option game. So let's say that there's 10,000 shares granted at $10 a piece, and that is the current fair market value. You would pay $100,000 for $100,000 worth of stock. There's not necessarily an economic benefit. There's not an economic loss to it. By the way, if it goes down in value, that is a stock option that is said to be underwater, and you would then not exercise it. You wouldn't pay $10 per share for a stock that's selling for $8 per share on the open market. In order to receive this treatment, first of all, it has to be in an incentive stock option plan, and granted, and it has to meet this $100,000 limitation. The individual, the person who receives it, the employee, must hold the stock both for 2 years from the date of grant and 1 year from the date of exercise. It must meet both of those. Those options. And when we do the in-class exercises, we will look at examples of those and how you have to check. Lots of times the dates are written in a very tricky way, where you meet the 2 years, but you don't meet 1 year, vice versa. So the grant date. So what are the tax consequences at each of these dates? At the grant date, there's no taxable income unless the exercise price is less than the fair market value at the date of grant. And I've not heard of a case where where the exercise price is less than the fair market value on the date that the grant is made. Normally they'll be exercisable at some date in the future, and you will only exercise them if the market value increases higher. And often they will be granted where the exercise price is higher. They'll be granted underwater, but sometimes they'll be granted at par where the exercise price is at the current fair market value at the date of grant. Almost never have I heard of where the exercise price is less than the fair market value at the date of grant. So, same thing, we'll see that this is the same rule for non-qualified stock options as well, by the way, on the grant date. So no tax consequence there. Upon exercise, here's one of the key features. Let's say that our $10 stock has gone up to being worth $20. So we buy the stock for $10 and it's now worth $20. We don't pay any regular taxes, even though we have an economic benefit. This is kind of like what we learned about earlier, this net unrealized appreciation. So this is a special benefit. Okay, again, this is not NUA. It's not called NUA, but it works like NUA worked before. You get this special tax treatment where you don't have to recognize any tax. And then upon the sale of the stock, you get a long-term capital gain treatment for the stock appreciation over the exercise price. So it's all long-term capital gains. But here's the key. I skipped over these two things, these AMT, because I don't want to just teach you what AMT is per se, at least not in too much depth. But this is one basic. Well, I'll give you a brief little lesson on AMT. Back in the 60s, there was complaint that a lot of wealthy people had all these tax loopholes, so they said, okay. And they were taking all these deductions, and they were going, hey, you know, they were making hundreds of thousands, maybe even millions of dollars, and they were taking all these business deductions and getting these special tax treatments, and all of a sudden they were getting down. So they were just taking advantage of the rules. So they said, okay, we're gonna say, oh, we're gonna run it a different way, and we're gonna do a second calculation. And this is just for you know, unless you hit it, then it's just for accounting purposes only. We're going to calculate without some of these special tax treatments. We're going to apply a lower rate, but there's going to be a minimum tax that you have to pay for it. One of the things that they add back in is this preferential incentive stock option tax treatment. So this incentive stock options could get you hit, and this is one of the things that frequently does get people hit, one of the most common things that frequently does get people hit with the alternative minimum tax. So here's, from an accounting standpoint, here's all you have to know, is that there's an adjustment, and so for now you just say, okay, this is what your AMT balance is, so it's just run a running tab, so that at the end of the year when you do the taxes, you compare the AMT to your regular tax calculation. So there's an adjustment equal to depreciation over the exercise price, but there's no so it's sort of like that little thing that you make for NUA. So it's except this is called AMT. And then upon the sale of the stock, then we actually recognize it, and then we have that negative AMT adjustment. So we take it in and we take it out. So the employer does not have any tax deduction related to the incentive stock options. Okay, when they are exercised in this qualified manner. So we'll see that when they are exercised in a disqualifying manner, not meeting the 2 years and the 1 year rule, then the employer does have some tax deduction. So here's an example. On January 5th, 2015, Bob, the VP of XYZ Corporations, got 10,000 ISOs at an exercise price of $10 a share. Over a year later, he exercises all of the options when the XYZ stock is $42. Now, it didn't have to be a year later. It never says that the exercise date has to be a year later than the grant date. What it says is that the sell date has to be a year later than the exercise date. Now, the sale date for Bob sells it for $60 a share, February 14th, 2017. Now, that is 1 year later than, so he had a year holding period after the date of exercise, at least a year and a day, and then 2 years. It's more than 2 years later after the date of grant. So this is a qualifying disposition. The date of exercise, so grant date, no tax consequences. At the date of exercise, Bob has no W-2 income. W-2 income, by the way, would insinuate that there's payroll taxes, or no ordinary income, but does have an AMT adjustment for the amount. So he had exercised 10,000 shares at when they were worth $42 a share. He only paid $10 a share. So for $10,000, he had 10,000 shares. He had a $32 gain. That's $320,000 AMT adjustment, which could cause him to pay AMT. But we wouldn't know that until the end of the year and looking at the rest of his stuff. Regular tax, he has so he has an adjusted basis because he's paid an adjustable basis of $10,000 because he is paid. $100,000 because he paid $10 per share for 100,000 shares. That's how much it costs him, $100,000. When he sells the stock later, $60 a share times 10,000 shares for $600,000, he has a long-term capital gain of $500,000. So it goes back to the basis that he paid. And then he has the negative AMT adjustment of $320. It backs that back out of there. Okay, so that's how that works, and we will do more examples of that in class. So a disqualifying disposition, if we acquired the selling stock acquired from ISO before 2 years from grant or 1 year from the exercise date, we just violate one of those things, and then we lose the favorable tax treatment. And we also then get rid of the AMT consideration. So here's the deal, though. We had this favorable tax treatment. Now we have to realize that when we exercise, we should have had ordinary income, and so not just ordinary income, W-2 income, which is subject to payroll taxes. For the amount. So going back to this example, Bob would have had $32 times 10,000 shares, $320,000 of W-2 income. So he pays ordinary income tax rates plus payroll taxes on that. At the date of exercise, and then appreciation after the exercise date equals a capital gain, either short-term or long-term after that. But now the basis, Bob's basis, if we look back at this example, Bob's basis would have been $320,000 because he had paid taxes. He not only paid the $10, but he had also paid W-2 income on the additional $32 per share. So his basis would be now $420,000. So the appreciation after the exercise date's capital gain. Employer has a tax deduction equal to the executive's W-2 income. So there's the key. On the disqualifying disposition, even in an ISO plan, incentive stock option plan, the employer can take some tax deduction if there's a disqualifying disposition. A cashless exercise is at least in part a disqualifying disposition. So a cashless exercise, as the name implies, the executive exercises an option without cash. This is something that's very common. So here's what happens. So I don't have the cash, and frequently that's the case. So I don't have the cash to, going back to Bob's example, I didn't have the $100,000. I borrowed the $100,000, or Bob borrows the $100,000, but he then immediately, and according to what this says, sells all of it. So it was, I think it was at $42 a share. He sells all 10,000 shares at $42 a share. So that immediately, that would be a completely disqualifying transaction, disqualifying all the shares from special tax treatment. And so then he would, in that case, it would go just like I talked about on the previous slide. There's something that also often happens is there's a cashless exercise where you sell to cover the expense. So you would only sell enough shares at $42 a share to cover the $100,000 expense and pay the $100,000 back. In that case, only the number of shares that you sold would be disqualified. The rest of them would still be could still be qualified if you held them for long enough for the 2 years and 1 year window for the special treatment. So in this case, at $42 a share, I think you'd have to, in order to cover the $100,000, you'd have to sell what, a little less than 2,500 shares. Okay. A cashless exercise is as we say, a disqualifying disposition. You would owe the W-2 taxes. So here's the cashless exercise example. Jason, executive, has 10,000 ISOs with an exercise price, an $8 exercise price. When the value of the stock increases to 32, he has a total value of 320. If Jason exercised today, he would need 80,000, ignoring any potential AMT consequences. Like many individuals, he doesn't have the 80,000, so therefore he sells it all and receives $240,000 in cash proceeds from the sale less than the exercise price. Of course, there would be taxes withheld. Since the sale of the stock did not meet the holding period requirements, the $200,000 will be subject to ordinary income and payroll tax. So that's what basically a non-qualified stock option works like as well. So if you disqualify an incentive stock option, it works like a non-qualified stock option. Non-qualified stock options, they can have more than 100,000. They can go to people other than employees. But here's the reason that we do them. Like incentive stock options has an employee benefit to the performance of the company stock. But even though that there's no favorable tax treatment. And because there's no favorable tax treatment, we don't have those statutory holding periods of 2 years and 1 year. So in a non-qualified stock option, same as the incentive stock option on the grant date. No taxable income unless the exercise price is less than the fair market value at grant date. Upon exercise, the executive will have the W-2 income, as we talked about in the example, and the employer does get the deduction. Upon the sale of the stock, there's a capital gain loss with a holding period beginning at the exercise date. In the incentive stock option, the holding period, the holding period began at the grant date because that was the well, you had to be 1 year and 2 years, but the basis went back to the grant price rather. Okay, now we see how non-qualified stock options work. Here's an example. On January 2nd, 2015, Ned, an executive of ABC Corporation, is issued non-qualified stock option from ABC Corporation with an exercise price of 10, which is the current market price. A year and a day later, Ned exercises the option when ABC has a stock price is 35. Ned brings the option in $10 to ABC. ABC issues the stock to Ned, and Ned, stock price is 35, so Ned brings $10 to ABC, and Ned recognized $25 in W-2 income from ABC. So Ned's new basis in the stock is now $35. So that's what it was worth on the date that he exercised. He later sells the stock for $50, even though it's now 2 years from the date of exercise and more than a year from the date of exercise and more than 2 years from the date of grant. Doesn't matter because this is not an incentive stock option. But because this is a long-term holding period, he gets to get the long-term capital gains tax treatment on the appreciation after the exercise date, not after. So the appreciation after the exercise date. So from the $35 to the $50, because it's more than an additional year, he gets the long-term capital gains. Oh, I'm sorry. If this were March 4th, 2017, that would be long-term. March 4th, 2016 from January 3rd, 2016 is only 2 months. So that would be short-term capital gains tax treatment. So that's how non-qualified stock option works. So ISOs gifting, unexercised ISOs can't be gifted. You have to exercise and then you can get the shares. Non-qualified stock options may be gifted if allowed by the employer, according to statutory reasons. They may be gifted. Now, when the donee, the person who receives it in a non-qualified stock option, when they exercise, then that is when the employee will have W-2 income and the employer will have the tax deduction amount. And the donee's basis equals the W-2 amount, just the same. The donee's basis will equal the W-2 amount. Stock appreciation rights. So this is the right to the appreciation. This is not actually the shares. So this works. This is similar to what we talked about earlier with the phantom stock in the previous recording for this chapter. So rights that the grant holder can cash in amount equal to the excess of the fair market value of the stock over the exercise price. Again, this ties the employee benefit to the value of the employer's stock, and it's, again, the employee does not purchase any stock, nor do they have the right to do so. Again, like the stock options, there's no taxation at the grant. Like the non-qualified stock option, there's W-2 income for the excess over the value of the exercise price. And again, this is essentially you get the appreciation, sort of as if that you exercise, like in a non-qualified, that you exercised and sold a non-qualified stock option in the same day, because basically, or any stock option in the same day. So there's W-2 income, but you receive the cash, and that's how that works. So here's an example. Jamie's a key executive at NT Company. She's granted 1,000 SARs at $10, the current trading, which is the current trading price of NT. If Jamie exercises the stock appreciation rights 2 years from the grant, when NT's stock price is 32, she will be entitled to receive $22,000, the appreciation. So went from 10 to 32, $22 per share for 1,000 as W-2 income. So that's what the employer says. Okay, the stock went up $22, so I'm going to give you that more or less like a bonus, but it'll be W-2 income subject to both income and payroll taxes. All right, that is the last slide for this recording, and we'll just have a few more slides to record for the fourth and final recording of Chapter 12.